planning group here at Point View. I'm joined by Donna St.Amant, our senior portfolio manager. We're going to talk today about building an all-weather portfolio. So let's get going. Okay. So it's been a crazy few months in the market, and if you haven't been nervous about it, maybe you're just not paying attention. It's easy to panic and react when in fact that's absolutely the wrong thing to do. You should create an investment portfolio and a game plan in advance of this sort of volatility that will allow you to withstand it, to roll with the punches, and to keep going. There are three keys to constructing that kind of portfolio. The first is asset allocation. What percentage of your assets should be in stocks, should be in bonds or fixed income, should be in cash? Within those very broad groups, you should diversify so that different pieces of your investment portfolio are moving in different directions. And then on a regular, consistent basis, you should be rebalancing your portfolio back to your original asset allocation. That sounds easy. And like so many things in life, knowing what to do isn't the hard part. Doing it is the hard part, and that's what we're going to focus on today. Deciding what your asset allocation is the starting point. And the good news is there's not a single perfect asset allocation for anybody. It tends to be a range. And the goal is to get within the range so that you can reach your long-term objectives, retire, educate your children, travel, leave a legacy, and still be able to sleep at night. So you do need to define your goals, to determine what your timeline is. Certainly, if you're trying to buy a house in the next couple of years, that's a very different timeline than putting kids through college when you've just had your children, or retiring several decades down the road. Your ability to save is also really important. Somebody at the beginning of their career who's got many years to build retirement assets is in a very different position than someone who is preparing to retire and may not have that many years left in the workforce. What I've got here is a couple of very basic charts for asset allocation. Ranging on the left is a pretty conservative one, where stocks are 50% of the portfolio. Fixed income, the ballast, is almost 45%, and cash is a small sliver. That's about as conservative as we want most people to be. Even if you're retired, you likely have a few more decades that you're going to need your assets to support you. You don't want to hide under the bed quite yet. On the right, where we've got the equity at 80%, that's about as aggressive as we like most folks to get. You still want some sort of ballast and stability within the portfolio. And I'm going to let Donna take it from here.
Okay, there's three basic components to your portfolio: the equities, fixed income, and cash, as Claire had mentioned. But each plays a very distinctive role. So the equity is the driver of growth. Most investors need equity returns to reach their savings goals. Even after retirement, individuals have 15, 20 plus years to live off their nest egg. So they need to keep equity in the portfolio in order to achieve, a high enough growth rate so that the portfolio can last them through those years. Fixed income provides the stability. Fixed income's role is really to be preserving a portion of your portfolio, protecting it. In a bull market, investors may be disappointed in their bond returns, but you really have to remember the growth is coming from the equities, and that the job of the bonds is to hold up and preserve your capital during a downturn. We suggest very little be held in cash. Money market returns are so low that cash doesn't even keep pace with inflation. But it does have a role for any short-term needs, expenses that you will need to pay in the next 3 to 6 months should be held in cash. And also, you should have an emergency fund for unforeseen circumstances like a job loss or an illness. So after determining your top level asset allocation that Claire was speaking of, then you want to sort of drill down and further diversify within each of those asset classes. A key point to make on diversification, it does not eliminate the risk of experiencing losses. And history shows that as an investor, you should really expect market declines every few years. But you want to stay in the market, ride out those times, just prepare for a downturn rather than trying to avoid them. So some ways to diversify, what we have listed here, these are diversification within the equity portfolio. You want to include exposure to all 12 economic sectors rather than making a large bet on, say, financials or industrials. You want to include some large cap stocks, small cap, put domestic exposure and international in the portfolio, growth and value. The key is really to spread your bets to reduce the volatility in the portfolio. And what we have illustrated in the chart here, the chart shows the correlation or the degree to which the performance of each of these different types of securities are related. The higher the correlation, the more closely this security will perform in line with the overall equity market. Point being that in a market downturn, your portfolio is protected by including securities with a low allocation to the market. You need to have that component in there with the low correlation. So the numbers in the chart, I know they're small. It's not really that important what the numbers are, but the red indicates a high correlation to the overall equity market, and green indicates a low allocation. And you can see, so the first column really shows the time period from 1980 to 2007 before a recession. And then the second column is during the recession, 2007 to 2009. So this is when the market, there was a market correction. So we want to see what happens to the correlation in that time, that period of a correction. And as would be expected, the first two, small stocks, international stocks, they are highly correlated with the overall stock market. And during the market downturn, that correlation becomes even higher. So you need to have, that's not helping protect you. So you need to have the lower correlated assets, which is the fixed income. So you can see there, gold, long-term corporate bonds, government bonds, treasury bills, all green, all low correlation to the market. And what's very interesting is if you look in the second column during the market downturn, that correlation gets even lower, which is good, which will help you protect the portfolio. And that's true in all cases except the long-term corporate bonds. And that's understandable because these are bonds issued by corporations, the same corporations that are issuing shares of stock. And during a recession, they may be experiencing or maybe struggling, so they're also going to perform more poorly. And it's for that reason that when we don't include a lot of corporate bonds in our fixed income portfolios, we would recommend investors stick with high quality government bonds, to get the best protection.
I'll just jump in and say the other interesting thing in here, we do get a lot of interest in REITs, or basically an investment in real estate. And certainly during the Great Recession, REITs had a pretty high correlation to the stock market. That's understandable. There was a big housing crash, but that does suggest that real estate may not be the best way to diversify your portfolio away from stocks.
Okay.
Mm-hmm.
Thanks, Claire. So looking closer at the fixed income performance. So no doubt the bonds are not going to grow your portfolio, as you can see by their outright returns. But again, that's not their job. We want the bonds to hold up during steep declines. So this chart shows several periods in time where there was a market correction. And the blue bar is the Bloomberg Barclays Aggregate Index, which is an index of high quality bonds. And the pink bar is the S&P 500. So you can see that through all of these market corrections that the bonds do hold up. And now, of course, they won't completely offset losses that you're experiencing, but they will protect that portion of your portfolio from decline. So if you hold 40% of fixed income of bonds in your portfolio, that 40% will be preserved, protected while you see through this equity downturn. And for people that are taking distributions from their portfolio, this protects a portion of their nest egg so that they can confidently continue to take their income. It also gives you a pool of money that is protected, that's liquid, that you can draw upon to buy additional equity during this market correction, as through rebalancing, which we'll get to a little bit later. And this will set the portfolio up to recover best when the market rebounds. And then Claire's just going to add, talk about the cash portion of your portfolio.
Okay. In general, cash is not really an investment. Cash is what lets you get through the ups and downs in the market. Certainly, unless, so long as you are in the workforce, you should have 3 to 6 months worth of living expenses in the bank in cash that will allow you to deal with job loss, with health emergencies, with needing a new roof or a new car, and it can help you basically ride out the ups and downs of the market. For a lot of people, just knowing they've got that cushion in the bank keeps them from panicking in the downturns. And we don't view cash necessarily as an asset class so much as an additional insurance policy. And then it's back to Donna for the real investing.
So investors' biggest fear is a severe market decline. And when the market is volatile like it has been this year, we're often asked, shouldn't I just sell or reduce equity now and then I can get back into the market after the crash? And while it seems like a great idea, time has proven that trying to get ahead of a bear market is really not a profitable strategy. Even if you are successful at selling and avoiding market decline, knowing when to get back into the market is even more difficult. So by the time an investor feels comfortable, it's likely the market has already rebounded. So the strategy is resulting in, the market is falling, you're selling your stocks at depressed prices at the low, and then you're buying back after a rebound. We're sort of chasing the market as it's recovering, buying as the stock prices are rising. So it's not really, it doesn't work out to be a profitable strategy, and more money is often lost in an attempt to avoid a market downturn than it would have been just following the strategy of setting it up properly allocated, rebalancing, and sticking through that downturn. So this is why rebalancing is so important. You need to prepare and then stick with the plan, which, as Claire said earlier, it seems simple. It's not complicated, but sticking through it in times like this year is really the tough part. So if you look at the slide here, for an example, say you have a planned allocation of 60% equity, 35% fixed income, and 5% cash. The market sells off, your portfolio drifts, your equities are worth less, so now they're only 55% of your portfolio, and the fixed income has grown to 40%. You need to sell the outperforming assets and buy the laggards. So you're going to sell fixed income and add to equity, which can be difficult when the markets, are as they have been this year. But you need to look for places where stocks are down, the sell-off has been overdone, and add back to the equity market, gradually on a disciplined schedule, and return your portfolio back to the planned allocation. And this supports the sell high and buy low, because you're selling these assets that are a larger part of your portfolio, so they presumably have done well. You're selling them at their high, and then you're adding to ones that have been beaten up, or perhaps beaten up too much with the overall market sentiment. And you really, most important is not how often you do this, but really sticking to a strict schedule regardless of market sentiment, and that helps to avoid trading based on your emotions. So the bottom line, you can't avoid the market correction, but this disciplined strategy will set you up for a recovery the best way when the market rebounds.
And this brings us back to the point that Donna made a little bit earlier, that having a significant chunk of your portfolio in fixed income can give you the assurance that you have enough liquidity and assets you can tap to give you as long as you need to wait for the market to return. And this
Again,
is
so yeah, oh, sorry.
Go right ahead, Donna.
Now, this is just one last point on this. You know, there is definitely a behavioral component to this. You know, we've both said it. It sounds simple, but you'd be surprised how difficult it really is to stick to this plan when there's a lot of swings in the market. So the fight or flight response, definitely not your friend. You know, but that's not to say that there's not a time where it is appropriate to change your allocation. The point is that these portfolio changes should come from changes in your life and not from market headlines and market sentiment. Any changes that you do make, you should be done on an incremental basis, sort of a planned time period, a little bit at a time. These could be, you know, changes in your life, like a job loss or something that changes your risk exposure. That would be an appropriate time to change your asset allocation. But you know, the market knows anything you do, meaning that it's very hard to get ahead of it and to get back in. So you want to try to fight back against these emotions and really stick with your rebalance plan.
Mm-hmm. And I mean, as human beings, fight or flight has served us well for hundreds of thousands of years. It has saved us from the mastodons, but it really doesn't work when you're dealing with the New York Stock Exchange. And to help, you know, give you a little confidence, we've got a couple of charts here as well. This shows a 60-40 balanced portfolio and how that portfolio has performed after some recent recessions. On furthest to the left is the 1987 stock market crash. Yes, if those of us who were around in 87 remember, the market went down 25% in one day. And certainly a month after that, the market was still down. Note it was down 4.8% after. So within a month it had recovered almost 20% of the 25% it lost. It was up after 6 months. It was up after a year, after 3 years, significantly up after 5 years, almost doubled within 5 years. The story is much the same. When in August of '89, there was a big hedge fund crash. Then we got the tech bubble, we got 2001, and of course we got the furthest on the right, we've got the Great Recession. And pretty much across the board, significantly up after 5 years. The only one of these that I would say wasn't significantly up was the dot-com crash in 2000. That's the one just right of center. That was a 2-year down market. It did take a while to get back. But compare that to September to 9/11, just to the right of it. Those two periods were about 18 months apart. And 5 years after 9/11, the market was up significantly. So hopefully this shows you that a balanced portfolio can recover quite nicely after a significant downturn, and you don't have to wait years and years for that to happen. Another version of this is the asset class winners and losers over a 20-year period. Although this chart is not to scale, the different colors represent different asset classes. Small stocks are the dark blue, large stocks the lighter blue, international stocks are the red ones. long-term government bonds, orange, treasury bills, which is short-term government paper, is the green, and your 60/40 diversified portfolio is the gray. Asset class winners over the 20-year period. Note how often international stocks are the best performing asset class, also the worst performing asset class. To some extent, that's the same case with large stock, with small stocks. The long-term treasury bills have done very well in bad years. You see that on the top, but they're also well represented as the lowest performing asset classes. So you really can't guess what's going to happen next. We talk a lot about how past performance is no predictor of the future. I think this chart shows you that. The other thing that should give you some comfort level is that, boring 60/40 diversified portfolio pretty much is hanging out in the middle, upper middle of that chart. It's never the best result, but it's not the worst result either. And for most of us, that's what we can live with. I know we've done a pretty speedy walkthrough of all of this. And what I neglected to say at the outset is you should have on your screen a little poll. We're going to leave it open for a bit. Just a question to ask you about rebalancing. We also have a Q&A box for questions if we've raised anything, and we do have one question. This is one we get a lot. I'm going to throw it to Donna. Clients often, when we are counseling clients to ride out the bad times, to stick with the plan, the response we often get is, well, what if it's different this time? So Donna, what if this time it really is different?
Well, I think you just kind of have to go back to that, last chart that you showed, or the second to last one. Of course, we never do know for sure what's going to happen, but the one before this, you just see a lot of proof here that through many different types of, crises, the market has rebounded. Of course, doesn't guarantee future results, but it's a pretty strong argument for sticking in with the market. And again, even if this time around it would last longer, you still have that portion of your portfolio in fixed income that is preserved, that can ride you out for a pretty long time while you wait for the market to recover. Mm-hmm. And it never is it's certainly not straight up, but it's also not, that we've had some good days and bad days. So if as long as you are kind of buying into the market a little bit, you're getting you're owning positions at these lower levels. Eventually that will help you to have more gains when it does eventually rebound.
And there are some tools that can help you. I know as 401k plans, for instance, become more sophisticated, a lot of them have an auto rebalance feature. So you don't have to go in and force yourself to rebalance the assets in your 401k plan. You can just set it up so it will happen. And I'm sure if that hasn't come to outside accounts, it will shortly.
There's a couple more questions here.
Yes. This is slightly off topic, but 2 days ago, the IRS issued some guidance about for folks who had taken money out of their IRAs at the beginning of the year. In April, Congress passed a statute saying no required minimum distributions in 2020. Folks who had already taken money out of their IRAs had very limited options. under existing law at that stage. 2 days ago, the IRS gave everybody until August 31st to put the money back in their IRAs. So that's good news. If you don't need your IRAs to support yourself and you can afford to put the money back and keep it off the tax grid until at least next year, you should take advantage of that opportunity. And then we've got a question about, are we in a bear market? And what do you do with older people who are already sitting in cash, with retirees? What would you say to those folks, Donna?
I'm reading the question, where do you put people in their 60s in cash? Like, how much cash do you have in a bear market?
Well, I'm thinking perhaps it's folks who are already sitting in cash. They're retired, they're scared. Now what do?
Like you said, it's hard to call when is a good time to get back in. So it's best just to get started, but do it in small increments. You could do it over 3 months, 6 months, a year, but just adding a little bit into the market, a little bit at a time.
Mm-hmm.
And, as far as the question about how much cash should people at that age have, it gets back to kind of getting a handle on how much you need for your living expenses. You want to be able to withdraw from that fixed income side of your portfolio for a number of years. But so you really don't need that much in cash. But again, the emergency fund, and it really depends if you have some upcoming expenses, you want to keep those, within, maybe within the next year,
Mm-hmm.
you want to keep those in cash, or at least a portion of it in cash.
Mm-hmm. Well, and in the beginning of this century, there was dividend paying stocks, particularly say utility company stocks or what we think of consumer staple stocks, those that pay that aren't big growth stocks but pay a regular dividend, became very, very popular. With low interest rates, people saw them as a bond surrogate, because bonds, as is the case today, have very little yield, and folks who want, retirees in particular, who want that steady income, we're looking for dividend stocks. Do we think that they're going to come to the forefront again?
Yeah, so there's some very good opportunities in high quality stocks that can add extra income to your portfolio that we definitely like. As a surrogate for bonds, though, I would go back to that correlation chart. Even the high dividend is not, the share prices can still decline significantly. So there's a place for them in the portfolio, but not in place of your bonds.
Mm-hmm.
We think we were talking about this just recently with REITs. REITs are very high paying stocks, and the nature of the REIT, they're paying out their income regularly in dividends. So they do have, they may seem like a surrogate for bonds, but they can also, as you saw in the correlation chart, the correlation increases when the market is experiencing a downturn. So they're not a surrogate for bonds. They should always be counted as equity. And they have a place in the portfolio, but you still want to make sure you have a solid fixed income allocation in the portfolio. High quality bonds.
Okay. So I guess we didn't answer one participant's question about, are we in a bear market? And even I'm willing to take a stab at this one. A bear market is defined classically as 20% from top to bottom. So there were a few weeks at the end of March, the beginning of April, where we may have been in one, but we are no longer in a bear market. All I can say in addition to that is watch this space. Who knows what's going to happen in the next couple of weeks, but it certainly seems that whatever's happening is happening pretty quickly.
Making it harder to, to pick spots and to time the market. Mm-hmm.
Here's another one for a retiree. What sort of withdrawal strategies do we use from accounts? And part of that certainly is trying to determine what one begins with, what's the withdrawal that we need? you'd look at we'd start with what are the overall assets that the retiree has, what are the sources of income. Hopefully you've got Social Security. There are folks out there who still have pensions. What's the gap that needs to be filled? And then once we agree on that, we set a monthly number that we send to the client's bank account. Then Donna can talk about how she actually goes about raising the cash on a monthly basis.
So for investors that are taking withdrawals on a regular basis, we again use this as an opportunity to do the rebalance. So we're going to, depending on how the market is performed and which asset class has overgrown, that's where we would look to raise the cash. We wouldn't necessarily just always sell your fixed income. If the equities have done really well, we'd sell equity. Or if the bonds are outgrown, we would sell fixed income or do a combination. And so we use it as an opportunity to rebalance, as you should when you deposit new funds into your account, or when you make withdrawals. That's a good time to do a rebalance.
Okay, we're about to end the poll. We've got one more question here for Donna. When we talk about buying high quality fixed income, how low is high quality?
Much lower.
And specifically, would we be looking at BBBs as a bond rating?
Right. So kind of two parts to that. We typically look at single A and better because we really want high quality in that portion of the portfolio. Some of the funds and whatnot will have own some bonds that go down to triple B. But these are really all, we stick in the investment grade space, which is triple B, single A, double A, and triple A. So triple B and above. Anything below that, the junk bonds, we really do not like to invest in, because this sector of the market, the high yield market, performs very much like equity. They're not giving you the diversification that you need. You already, particularly for investors that have higher equity allocations in their portfolio, they already have this exposure. So the high yield bonds really don't do anything to diversify. We might look to include in the fixed income portion, for most investors, we are sticking with the single A, government type of single A and above government type of bonds. We might consider going to corporate bonds for somebody who's 50-50, so a more conservative portfolio that on the equity side, we might go with a little bit of corporate exposure, but for the most part, it's the government bonds, and we don't really look to invest in the high yield.
Okay, thank you for that. Okay, so that's what we've got the time for questions for. We did ask you how often you rebalance your portfolio, and I'm pleased to say that 2/3 of you say that you do rebalance on a regular basis. Fewer than 10% of you rebalance when you're scared by the headlines. And about 1/4 of you never rebalance your portfolio. So specifically for that group, I would look at tools that would rebalance for you so that you don't get too out of whack. But we do appreciate your spending part of your summer afternoon with us. We've enjoyed talking about this topic. If you have questions about this or anything else, we would love to hear from you. Our contact information is on the last screen, or you can reply to the invite. Thank you so much.